Welcome back to the Portfolio Podcast. It's been about a month since the last episode, so we've got a fair few things to catch up on. First one is, you may notice there's no Hani about. It seems to have dropped off the face of the earth, so we're going to do a few episodes with just me and hopefully see how they go. I mean, it's going to lose the two-person dynamic a little bit, but I want to get some consistency going with the upload and get some regular content back out. It's been a fair number of changes going on with the portfolio. So one of the big things that's changed recently with my portfolio since we last did an update was to do with my holdings in the Renewable Investment Group, shortened to TRIG, so we'll refer to it as TRIG from now on. I had an email on my Hargreave Lansdowne account that basically said they were doing a 10-to-1 stock split. For those of you who don't know, a stock split is basically if a company's trying to raise more capital for an investment purposes or to pay down some debt, they'll do an issuance of new shares to existing shareholders and say, hey, we're gonna ask for some more money. Here's the reason we're asking for some more money. Do you want to keep your proportion of shares in our company and therefore buy some more shares for these reasonings? Now, we're going to do a bit of digging into the Renewable Investment Group and that particular offering as to why they were doing it. But just for full disclosure, I took up the offering and some more, so I hold 1,500 shares in the Renewable Investment Group, so I had the option to buy another 150. And I made a decision to buy 1,020 in total because of the information. Hopefully, I'll review to go through here. So the Renewable Investment Group is basically almost like a REIT for renewable infrastructure, renewable energies. TRIG have a investment portfolio consisting of both on and offshore wind farms and solar panels, which you can see on the map here. They stretch fair way across Europe, and they are continuing to grow and stretch this portfolio, and this is one of the reasons for the stock offering. Now, what I've done is I've gone through and I've reviewed the stock offering documentation to just say, have a look into what they're asking and for the money for and what they're trying to do with that money. Before we get into the meat of that document, what I first want to do is just go through why I invested in TRIG in the first place. So one of the main attractions for me being a dividend portfolio is its current 5.5% dividend yield. So that's above my 4% target I've been trying to hit with it. Just for context, this website Dividend Max is one of the key ones I use to just assess how a company is performing based on their dividend. It gives a good track history of what their dividend payments have been, what the predicted next dividend will be, and what the previous dividend was. What I also quite like is they give an accuracy rating on their predictions. So if they're wrong, they tell you they're wrong. So it's quite a useful one that goes on there. Now, as we can see from the chart here, since TRIG was floated on the stock market in 2013, their dividends have been increasing consistently year on year, and that's something obviously you look for when you're going on dividend investment. Being in the energy sector, you're not expecting huge growth. The whole point of energy stocks is they just pay you consistent dividends and you just get gradual growth going forward. But thankfully, being the Renewable Investment Group, what we're hoping to try and see is that as we transition more away from fossil fuels and get more towards using solar and wind energy, that they continue to grow their portfolio and hopefully continue then to grow their dividends. I wouldn't want to be going out and investing in companies that are obviously heavily reliant on fossil fuels given the way the market's changing at the moment. So this is the December 2020 end of year financial statement from TRIG. As always, it's a really heavy detailed document, so what I've gone through is I've just gone through and highlighted some of the key points, and I'll just reiterate on some of those just to try and break down and reduce the amount of reading you guys have to do. So end of 2020, the portfolio of the infrastructure they had produced 3,953 gigawatts. And the good thing to see is that's increased by 900 gigawatts since last year. It's always positive to see growth, and it's good to see that they are continuing to increase their output and hopefully increase the amount of profit, which we'd like to see. Now, you'll see here it has a net asset value, NAV, as you'll put in the document, of 115.3 pence. So effectively what happens is the current share price of about 120 pence is above the net asset value, which means the assets in the portfolio are worth less than what the current share price is trading at. Now, what that's likely down to is people paying a premium on the shares because they are continuing to grow. So people are front running the stocks, as you would see when you see a dividend of 2% on a stock. It's likely because people are expecting a big growth or a big increase in dividends going forward. One of the big points in this document, which I think has spooked a lot of investors and driven some of the recent downside action we've seen on this particular stock, is the actual drop in earnings on 2020. So in 2020, there were ordinary earnings per share of 5.9 pence, compared with 2019 at 11.4 pence. Now, some of you might have already noticed that, hang on, they're paying out a dividend of 6.76 pence. How can they sustain this when they're only earning 5.9 pence per share? One of the big ones that's driven this, and they hint at this as a document, is the actual dampening in the wholesale price of electricity. This chart shows the historic wholesale price of energy within inside the UK. Now, what you can see on here is that across 2019, before the pandemic, we were holding pretty steady at around £40 per megawatt hour of electricity. Then you see suddenly at the start of 2020, when the pandemic hits, there's a massive drop off down to nearly £24 per megawatt hour of cost for electricity. Now, the reason this happened is that you'll see that energy usage across the sector within inside the UK, that as industries shut down, as the entertainment industry all shut down and everybody went into lockdown, drastically decreased. So what happened is demand for electricity has reduced, the supply has remained the same, so therefore the cost of electricity is going to be driven down. The good thing is that TRIG are going to maintain their dividend of 6.76 pence for the year of 2021, so there is no cut in dividend coming. Admittedly, there's no increase in dividend, but that's not necessarily a bad thing at the moment given what's been going on. Part of the reason for doing this is, as you can see from this chart here, the wholesale price of electricity has begun to climb again. So what's happened is that industries in the UK are starting to reopen as the lockdowns have been lifted at, and you'll see that recently in the month of January, the wholesale electricity prices climbed to almost £60 per megawatt hour. Now, I suspect what's happened is that certain energy producing methods have been taken offline to cope for the reduction in demand of energy. So therefore, there's now slightly lower supply than there was originally. So now things are starting to open back up again. Energy prices are going back up again. Hopefully what will happen is that this will actually smooth the curve and smooth that lull, so it won't really have too much of a knock-on effect in the long term for TRIG. Obviously, in their 2020 financial statement, it will show as a slight hit, but in 2021, hopefully, you'll see a recovery in their EPS. This reduction in wholesale electricity price is something that features quite heavily throughout this financial report, but I think there's two statements I want to touch upon that summarise it quite well. First one on the screen here is that the average power demand since the 1st of April 2020 compared to business as usual has ranged from 2% less in Sweden to 6% less in the UK, with even greater short-term variability. So that sort of summarises a statement we made about the reduction in energy usage throughout the UK. The second statement is this one here, which is the limits of movement and the activities of people following the outbreak of the pandemic significantly depressed demand for electricity in 2020, contributing to greater power price volatility and lower overall price power forecast. The timescale for recovery in economic activity is uncertain. Now, that statement about being uncertain about the timescale is hopefully a bit more in the past now. Obviously, it's a slightly older report from February, and we are starting to see the UK coming out of its lockdown, and we are continuing to meet the requirements for us to actually get back to business as usual, as they call it in here. Nonetheless, the threat of climate change persists. The decarbonisation agenda has remained central to the government policy across Europe, with increasing electrification of energy systems and renewable build-out at the core of further policy developments. That's quite an interesting point here, because obviously where I talk a lot about electrification of vehicles and stuff like that, that energy has got to come somewhere, but at the same time as electrifying our transport industry, we're also having to decarbonise our energy industry, so therefore the demand on renewable infrastructure is basically got a double pull on it, because there's a massive amount of energy that we use in our transport sector. Arguably, the amount of energy we use in our transport sector is larger than what we use in our domestic and our commercial usage. So we almost basically need to double the effective capacity of what's on the grid to be able to produce the energy to power our electric vehicles if we continue down the path we're going down. So this is where companies that are dealing with renewable energy have got huge amount of growth potential. Now, this is just one. This is just looking at portfolio and actually dealing with the actual energy being delivered to the customer and making a business out of that. There's other areas you could look into if that's something you're interested in investing in. There's a country like Siemens, which make wind turbines out there. It's another one we might have a look at some point in the future. A couple of other key points from their financial statement is the fact that they're showing their portfolio is still growing. They're still making investments. They're still trying to improve and grow the amount of infrastructure they actually hold. So in the end of financial year 2020, they made a total investment of £88 million, and they disposed £118 million. So effectively what they're doing is just rebalancing the portfolio. So they might have a couple of wind or solar farms which aren't keeping up with the rest of the portfolio, so in order to improve the quality, they're actually selling those on to other companies or other individuals, and then buying in and using that capital to buy in hopefully better value assets. It's something that's good to see. Another key point I want to touch upon was that the dividend was still covered, so they had a dividend cover of 1.13 times. Now that's not as strong as you might look for in some companies, but it also shows that they shouldn't be hopefully cutting their dividend anytime soon, and will continue to keep up with the rate they're going with. And with the increase in energy prices we've just been talking about, hopefully in the near future we might actually see that start to climb back up again. So now if we hop into the prospectus which is released along with this stock offering, we can start to get into some of the details and look at some of the key points within here. So one of the key things they noted at the very start of here is that this share issuance they've done recently and has now closed might not necessarily be the end of it. So they, over the 12-month period, they might do an issuance of 600 million new shares. Now the share issuance they've recently done was for one share for every 10 that currently exist, which is equated to about 190 million shares in total. So it's only using about a third of what is currently they could currently offer in new shares. So what I would advise anybody that is interested in buying TRIG and doesn't already hold some, or anybody that does even already hold TRIG, is actually be aware that there might be further stock issuance if they wish to raise more capital. The shares which they sold in the last issuance were done at a price of 123 pence. Now the price is around 120, so there was some selling pressure post that issuance being done, but that price was based on a market average over a previous period. So any new stock issuance should be done over a previous period. Doesn't necessarily mean they will issue new shares. It's just they have the option to do so should they wish to raise more capital. And what I will be interested to see is any of the publication that comes out from the company post this stock issuance that's happened, basically saying, oh, we had great take up and people were interested in it, or we didn't have enough take up, and what the reasonings behind it were. So that's something that I'll definitely be keeping an eye out for. If we go a little bit further down the document, we start to understand the reason why the company's doing the share issuances. So this statement here, the company currently has £65 million in drawings under its 500 million revolving credit facility. Basically, they have the option to withdraw debt of up to 500 million with very little questions asked. So for them to only use 65 million, that is actually quite a good sign. A lot of companies nowadays are running really high debt levels, so even though their asset portfolio is worth 2.2 billion, to only have 65 million in debt is great. So it's a good sign that they're actually got a healthy balance sheet. As of March of 2021, the company also has outstanding commitments of 392 million with respect to a number of investments. So effectively, they're continuing to grow their portfolio and they are doing a load more acquisitions. So this share issuance and this capital raising which they've done is mainly tried to actually increase the value of the portfolio. Yes, they're probably going to pay off for some of their debt, but they're actually going to use it to increase the value. And just going back to that point we were on about earlier about the increasing energy demand on the grid, this statement also captures it quite nicely. So the UK government's analysis suggests electricity demand could double by 2050. Now this is where I was on about electric vehicles entering the market and obviously needing to be charged off the main grid. Secondary to that, the UK government is reiterating the point that they're trying to increase their offshore wind capacity to 40 gigawatts. Now, if you look at sort of the actual UK usage at the moment, it is only currently about 40 gigawatts total. That includes all gas, all nuclear, all imported power from France, Ireland, and wind, solar, the whole lot. So with the UK saying we're trying to get to 40 gigawatts of offshore wind, it shows massive growth in the actual wind sector, and companies like TRIG will actually be doing further investments and continuing to grow their infrastructure and hopefully therefore continuing to grow their profitability. One of the key things which they also note inside this document is the fact that as their infrastructure grows, their overhead costs as a percentage of what it costs them reduce. So this is that statement here. The company's fixed running costs will be spread across a larger equity capital base, thereby further reducing the company's fixed ongoing expenses per ordinary share. So as part of this first off stock offering, TRIG are actually offering 195 million shares, which should raise them a capital of about 240 million pounds. Now, as we looked at earlier, their total investments they're trying to make for the first quarter is over 300 million, and their debt is at 65 million. So effectively, what they should be looking to do is raise an additional 400 million. So I wouldn't be surprised if they do actually do a second offering later in the year. Now, Obviously, I've already gone through and bought more than my offering, so currently I sold 2,520 shares in them. So if they did another, say, 10-to-1 stock split, I would then have to buy another 252 shares in order to keep my proportion that I own of the company the same. What I made sure I did is that when I made the decision to purchase more shares than that, I was prepared to do that. So should they do another stock offering, looking at the information I've seen here, looking at what I believe will happen in the market, I'm actually more than comfortable to say, right, okay, I will buy another 250 shares at £1.20 a pop. So I'm willing to put another £400-500 into it. And even if the time comes there and I need to increase my percentage of my personal portfolio, which TRIG makes up, then I might potentially go and buy a further 1,000 shares, for example, and increase my actual stake in them. I think one thing that's positive to see is that in this statement here, the directors are actually purchasing shares themselves. People that are running the company are showing that they actually have faith in the company. But yeah, that pretty much wraps up the look into the actual TRIG stock offering and what I did with my investment with the money I put into my portfolio in March. So I think it's about time we actually hop back to the main portfolio and just see what's been going on while we've been off for a month. So you see the portfolio has been steadily increasing in value, continued to go on. It's good to see that some of the biggest loss makers have actually been recovering, particularly the alts. So one of the key alts I hold is Binance Coin, which has been doing incredibly well over the last few days. Cineworld has also been back on the come up, and so obviously the recent announcement on April the 12th that the UK will be coming back out and things like cinemas will be able to reopen is absolutely brilliant. So that's going to help drive price of those stocks up. Again, New River Residential, one that we've had our Ryan had an 11% increase on that announcement. So that's always positive to see. They're quite heavily exposed because they have a lot of pubs inside their property portfolio. Obviously, main driver has always been crypto. It is on a sort of pause that's been going on at the moment. It's in a sort of settling period, hopefully before the next leg up. Two key things I am going to look at is I've been getting closer towards my £1,500 dividend target for the year. I think I'm only £9 short of being able to actually forecasting to reach that amount. So what I'm actually going to try and do with some of the purchasing I do over the next couple of months is actually looking to get in a couple more growth stocks. Obviously, I'm going to gradually start selling out my crypto portfolio at some point, so I need to make sure that I'm re-exposing myself to certain growth stocks. There's a number of companies I'm going to look into, and I'll be doing some episodes on those. One that's of particular interest for April is the actual IPO of Coinbase. So although it is still crypto related, it's a lot more stable because if the market goes up, exchanges make money. If the market goes down, exchanges make money. It's that classic Wolf of Wall Street thing where you're the one buying, facilitating the buying, saying it doesn't matter what the market does, you make money. And if you actually look at their revenue and the amount of volume they're trading and the continuous growth in users as the crypto space is growing, it's absolutely fantastic. So I'm definitely looking at trying to buy into the Coinbase IPO, and we'll do a whole other separate episode on that. One other thing I would just like to have a quick look into is obviously dividends for the end of March totaling £113.83. It's one of what I've had classed as a medium month, as I said, so it's the third month I've had over £100 now. Next couple of months should hopefully be a lot bigger because we've got dividends coming in from companies like Phoenix and Legal in general, and they make up large parts of my portfolio, and they'll be chucking out nearly £100 dividend for their their semi-annual dividends. So it's always good to see. So hopefully that episode's been okay. I know it's just me, so we've lost some of the dynamic on it, but forgive me for that, and we'll see how we get on. So hopefully you've enjoyed the video. If you have, like and subscribe, and we'll see you later. Bye.